All right, so I'm Colby Traw with Ignite Funding. So Ignite Funding, what we do here is first trust deeds. For those of you that aren't familiar, they're a debt instrument, essentially private lending to construction companies and developers, mostly through the Western United States, right? So people that don't want to get into long-term holds, fix and flips, anything like that. They don't want to deal with, the headache of tenants, roofing, plumbing, nothing against that. You can definitely, make good money through those venues, but they're coming to us for their more passive real estate exposure, right? So a little bit about what we do and what we offer. So our loans, they usually range anywhere from about $1 million up to $15 million to these construction companies and developers. And they could be acquiring land, they could be developing that land, or doing the actual vertical construction. And so what we do is we essentially crowd fund those loans or fractionalize those loans for the developers. And then in return, those investors are getting a fixed interest rate between 10 and 12% that's paid in the form of a monthly interest payment, right? So you're essentially acting in the capacity of a bank. You're essentially getting high interest fixed income for the duration of the project, which is usually between about 6 to 18 months in duration. So just a couple points here about trust deeds. As I mentioned, they're all going to fall between that 10 and 12% here at Ignite Funding. They are collateralized, so you're going to be recorded on that deed of trust, get your secured promissory note, as well as the final title insurance report. We usually have about 3 to 5 projects available at any point in time. They are pretty short term in nature compared to a lot of other real estate investments. So the usual structure of these loans is a 9-month loan with an optional 9-month extension for the borrower. So you, the investor, have to be prepared to be invested for that full 18 months, although it could pay off early and there's no prepayment penalty to the borrowers. It produces monthly cash flow. It's very passive. And it's also very easy to diversify across different borrowers, different asset classes, geographic locations, and arguably most importantly, you're in control to pick the investment, right? You aren't investing into a fund with Ignite Funding. We're just producing the opportunities for you, and you get to decide which project or projects that you want to invest into. So a little bit about Ignite Funding. We've been around since 1995 doing this type of lending, moved more into the commercial space back in 2011, and since then have originated close to $1 billion at this point. And when I say commercial, we do things like assisted living, student housing, warehouse industrial, but we also do some residential. But if it is residential, it's usually not single family residential. It's going to be more apartment complexes and master plan communities where they might be building 100, 200 townhomes that we're helping them with. We occasionally will do a high-end custom home that's already pre-sold, right? 7,000 square feet, something, in that realm there. But that's more of a one-off versus the rest of what we do. We do everything from A to Z here at Ignite Funding, so we don't outsource any of the stages. So we originate these loans, we do the capital fundraising, the loan servicing, collection and disposition. So if it ever does go into default and foreclosure, we do handle that in-house on behalf of the investors. Of course, they get a vote, but we handle that in-house. We don't outsource that to other companies like a lot of loan originators do. These loans, they're anywhere from 10 to 12%, as I mentioned. So who are the borrowers, the people that we're lending these funds to and that our investors are lending to, right? We're not lending to folks that go to fix and flip seminars, anything like that. It's a lot of regionally recognized developers and construction companies with proven capability in their field of expertise within real estate. So just for an example, we have a group here. We're in the southwestern United States, so Henderson, Nevada, Las Vegas, Nevada. So quite a bit of our lending is here in the Southwest. We work with a group here locally, Harmony Homes. They've done over 400 loans with us for over $200 million. A group, Local Homes, out of Colorado. They've done about 102 loans with us now, a little over 100. A group, Rhino Holdings, done about 30 million with us for, 30 loans for about 150 million. So what our clients like to see is this track record of these borrowers coming back to us time and time again. They get more comfortable, helps them feel more confident in these investments that they make. And obviously it's a good sign because these borrowers have such strong margins that they're coming back to us for repeat business. And then our investors, right? People like yourself. So what you're looking for, usually capital preservation, monthly income, portfolio diversification, and transparency. Most folks that come to us, as I mentioned, they're looking for a passive real estate investment. You do some due diligence up front on the specific project. And then once you invest into that project, it produces you monthly cash flows. You're getting an ACH directly back to your bank on the 15th of each month for the interest that you've earned. And then once that project pays off after those 6, 9, 12 months, you receive your principal back same way and can look at the other projects we've got available at that point in time. And minimum investment is only $10,000 per project. So it's very, very easy for folks to dip their toes in the water, get more comfortable and see, how that process works. So you want to know where you're investing is secure. Of course, we're looking at things like supply and demand, job economic growth, population growth, desirability, STEM growth, things along those lines, all taken into consideration with our underwriting department. So our underwriting team, we service right now about 220 million in loans. So we're at a small enough level that our underwriting team can go out and visit every single property that we lend on, meet with all of those borrowers. So it's very intimate touch that our underwriting team has, and of course is looking at where the market is moving for both asset classes as well as maybe some markets that we want to start to move out of. And so I think this is very important in terms of where Ignite funding lends. It's pretty much Colorado, Texas, and West, excluding California. We do lend a little bit out east, but it's more of a rarity. And the reason for that is because we lend in trust deed states rather than mortgage states. So these loans that we originate, these are going to be first lien positions 99.9% of the time. And so obviously that's extremely important. And so why it's important to be in these trust deed states rather than the mortgage states is if it ever goes into default and foreclosure, right? There's no perfect investment, there's risk involved. Well, when you're dealing with trust deed states, you can actually take a property back through default and foreclosure in 3 to 4 months, depending on county law. Whereas when you're dealing in a mortgage state, you have to go through the judicial process, right? So you have to go through the courts to actually take that property back. As I mentioned, we've been around since 1995, so we did some lending out east and in the Midwest historically, and it took, sometimes years to take those properties back through default and foreclosure. Of course, none of our investors want to be tied into these projects, not earning interest for extended periods of time. And so when you're lending in the Western United States with these trust deed states, you're able to take them back much quicker. Also, it is where we're seeing a ton of growth right now. So as I mentioned, we're here at Las Vegas. So I would say probably about 35% of our portfolio right now is here in Las Vegas. A lot of it is on the residential side of things with these master plan communities. And so what COVID has really accelerated is the amount of people that have been moving to Southern Nevada, also places like Arizona, because right now we're having about 400 people a day move from Southern California into Las Vegas every single day, right? So that's putting extreme demand on these home builders. They come to us to acquire that land, get it developed, and go vertical. And a lot of the time they're actually pre-selling these units before they're even able to get them fully built out, which is great for our borrowers. They're able to increase their prices and margins as well. Other markets that we're seeing a ton of growth right now, areas like Boise, Nampa, Meridian, kind of all of those surrounding cities there in the Boise market. In Colorado, we're seeing quite a bit of growth down in Colorado Springs, Fort Collins, as well as down in Phoenix, Tucson area. So that's the majority of the lending we do. Places like North Carolina out east, we also do some loans out there. So it's not that we won't lend in the Eastern United States, it just has to be the right opportunity And for us, we're seeing a lot more in the Western United States at this point in time. So you want to know when is a good time to get into real estate. I'm sure everyone that's viewing this has heard about real estate prices and how they're going up. Nothing different here. So it's a great way to get your passive real estate exposure, kind of cash in on that. You're not going to be hitting home runs, but your investment is going to be collecting that 10 to 12% annualized in the form of a monthly interest payment, and you're collateralized by that physical piece of property in a first lien position. It's definitely a special opportunity in the market right now. So a little bit more of a definition for a trust deed. So for those that aren't familiar, just like a bank has the mortgage on your home, if you ever stop making your mortgage payment, they're in a first lien position, so they can take that property back and sell it to recoup principal or their initial amount lent on that property. Very similar here, you are acting in the capacity of a bank. So the trust deed is essentially the security instrument, your collateral for that loan, right? So each investor is recorded on that deed of trust with their proportional ownership. So say you invest $100,000 on $1 million note, your name is actually recorded under Exhibit A on that deed of trust with your 10% ownership stake of that property. It'll also come with a secured promissory note, as well as a final title insurance report for that property as well. And so, as I mentioned, one of the beautiful things about these investments is that you, the investor, get to decide which project or projects you want to invest onto. So we really cover the entire spectrum when it comes to real estate, acquisition, development, and construction. So when it comes to acquisition, that could be acquisition of land that's already zoned, or it could come in the form of acquisition of an existing structure. Right, just about 2 weeks ago, we did a loan down outside of Tucson, Arizona. It was an old hotel, and of course, COVID has hit hotels very hard. So what they were doing, using our funds for, is to acquire that hotel and then convert it into an apartment complex. Right, so using our funds to acquire it, as well as do some construction improvement work to get it ready to be an apartment complex. So acquisition kind of takes two forms there. I would say probably about 30% of the loans that we do are on the acquisition side, whether it's land or the existing structure. When it comes to development, right, the horizontal development of that property, I would say that's the majority of our business. Probably about 50% of the loans that we do are going to come in the form of the development stage. A lot of banks, they're hesitant to lend on land acquisition or development. But that is where we are extremely comfortable. That's where our expertise lies. And so that's why about half of our loans that we do are in that development space. And then, of course, what everyone's most comfortable with is construction, or most familiar with for the most part, comes down to construction. So I'd say about 20% of the loans that we do for our overall portfolio are in that construction realm, both on the residential as well as on the commercial side of things. So you want to know what you're investing into. So each of our clients, we've got about 2,500 clients nationwide as well as internationally in all 50 states. For each project that we release, we send out what's called an investment overview. It's going to be a 1 to 3 page due diligence packet. It tells you where the project is geographically, who the borrower is, what's their history of doing this type of project, what they're using the funds for, the loan to value, loan to cost, exit strategy, right? All of those kind of key facts that you would want to know before investing into a project. We send that out to all of our investors. Additionally, if you ever want to see borrowers' credit reports, financial statements, tax returns, preliminary title reports, we provide that to all of our investors for each investment that they make with us. And then additionally, it's important to know how that property was valued. Right. The majority of the time, we're going to be going out and getting a BPO or a broker price opinion on that piece of real estate. So that'll be a third-party opinion of value, or we'll get an appraisal, or if it's acquisition of land, sometimes we'll just go off the purchase contract. But we're always going to go out and get that third-party opinion of value on the property, making sure, you know, that what we value the property at is what a broker thinks they could actually sell that piece for at the end of the day. And that's, of course, what we will market is what the broker price opinion or appraisal comes back at. And so we provide all of that for our clients, each investment that they make with us. So as I mentioned, those are kind of the three valuation methodologies that we use here at Ignite Funding. When it comes to loan to value numbers that we're looking for, land acquisition, usually up to about 60%, development up to about 65%, and then construction might be as high as around 75%. Those are more of kind of the mid to upper limits that we're looking at. We just had a project, it was Phoenix, project out in Phoenix where it was a assisted living project. It was already an existing structure. They were just converting it and building it out to be an assisted living facility, and it had a loan to value of 46%. So it really is just project specifics. Those are more kind of the upper limits. Excuse me. So if you look at our average loan to value in 2019, it was just a hair under 60% at 59.42%. And then here last year in 2020, I believe it was around 62, 63% on average across all of our projects. So kind of that, 65 is kind of what we're shooting for on the whole. That's extremely important, right? That shows you how much equity these borrowers are putting into these deals. So they've really got quite a bit of skin in the game. They're going to be very hard pressed to ever want to walk away from these projects in a worst case scenario, because at the end of the day, the property is the collateral for you, the investors. Touched on this a bit already, just about how you're legally recorded on that deed of trust. So as you can see here down on the right side, it'll be recorded on the deed of trust under Exhibit A. It will have your name listed there, as well as your percentage interest in that overall project. You're going to get that secured promissory note, as well as title policy and property insurance as well. So you want to know what happens if the borrower stops paying. Looks like we got a question. Give me 1 second here.
I'll get their info for you, but they wanted to know about the slides. I'll get all that for you.
All right, perfect. Appreciate it, Jeremy. So just about what happens if the borrower stops paying, right? And so this goes into the risks of these investments. As I mentioned, there's no perfect investment. We don't claim to be by any means. But if you look at our track record, since 2011, about 4.25% of the loans that we originate go into default and foreclosure, right? The other 96% of the time, everything goes as planned. You get your monthly interest payments. The project pays off after those 6, 9, 12 months. But what's important is the risks when you invest into these first trust deeds, right? So in that, 4.5% that go into default, it's obviously important to understand that you aren't losing everything. You are in a first lien position. So in those projects that go into default and foreclosure, we actually return on average about 98.5% to our investors. So on average, about 1.5% loss when we do have to take those properties back, right? That's a number we're extremely proud of. And it's obviously important that you're getting in at those good loan to values and have kind of backup strategies, have groups that you work with who would be willing to acquire these properties. And that's part of what our underwriting does ahead of time, is making sure we work with multiple borrowers, in that certain asset class in a geographic location. So if we did have to sell that property, we do have kind of a group lined up. It doesn't always get sold that way, but you want to make sure that you do, dispose those properties for as much principal at the end of the day. Of course, there have been, projects that have had, 10, 15, 20% losses. But at the same token, we've had to take properties back through default and foreclosure that have had, 20, 25% gains. And that all goes back to the investors at the end of the day. So with these defaults, we're going to be communicating with you. We've got a default portal that we share all of the information and updates with the clients about what's going on with the property, what stage it's at. Additionally, if we get an offer on the property, say we lend, just simple math, we lent $1 million on the property, we get an offer from a group to buy that project for $950,000. Ignite Funding does not make the decisions on behalf of the investors. You, the investor, actually get balloted and get to vote how you want to proceed with that property, right? So if you invest $100,000 on the $1 million note, you have 10% of the votership rights to decide how to move forward with that project, right? The 51% majority or more, that is how Ignite Funding moves forward with that project, whether that means selling it at a certain price, holding it for X amount of time. We've never done a capital call. So previously, say that there need to be a final layer of paint or windows put in. Ignite Funding historically has fronted all of those costs, and then upon the sale of the property, recouped those fees, right? So that's how we've kind of settled these default and foreclosures in the past, and you, the investor, get balloted to decide how you want to move forward with that. Perfect. So as I mentioned, about 4.25%. So that was as of the end of the year, about 4.5% loans go into default and foreclosure. But at the end of the day, Ignite Funding, we are a private company, but we treat ourselves like a public company. If you go onto our website, you'll be able to see our track record broken down year by year, every loan that we originated, what asset class it was it acquisition, development, construction, the average rate of return, average duration, right? So mentioned it's usually between 6 and 18 months. Last year, the average was 12 months, and in 3 previous years, the average project lasted around 8 months. But we treat ourselves like a public company. You're privy to all of that information. And additionally, we have a default portal that you can see all of the loans that have gone into default and kind of the resolution percentages, all of that information. So we try to be as transparent as possible with our investors. And that's obviously suited us very well here in the past.
So Kobe, we have some questions. You ready for me to ask them?
Absolutely.
Okay, so can you just kind of quickly tell us how trust deeds compare or are different from like a hard money loan?
Mm-hmm. Yeah, great question. So at the end of the day, first trust deeds and hard money are very, very similar. That is at the end of the day what we do. This is a hard money loan to a commercial developer or construction company. So we're just working with a lot more, I guess, credible groups than you typically think about when you hear hard money loan, right? But at the end of the day, you are in that first lien position. You are lending on that physical asset itself. And so if anything were to go wrong, you have that property as collateral, just like a hard money loan, right? And that kind of goes into another point is what kind of recourse is there on these loans? You have the property, and a lot of the time you'll also either have a limited recourse guarantee for one of the borrowers or a full recourse guarantee on that project. So you can go after their personal assets if there's ever a deficiency claim there.
Awesome. I'm going to combine two, I see. How do you guys compete with banks? And then secondly, did you guys experience any issues or defaults in 2020 during coronavirus?
Great question. So how we compete with banks, as I kind of alluded to earlier, a lot of banks aren't going to be lending on land acquisition and development. They're only going to be lending on construction and those finished projects or products. And so we're really not competing with banks when it comes to the development and acquisition side of things. And I would say 90%, maybe even 95% of the time, the way that we're getting paid off is through a traditional bank refinance, right? Being that we're working with these larger developers and construction companies, they all have established bank relationships. And that's how we're getting paid off. The reason why they come to us is mainly for speed, right? Our average loan is about $5 million, and it only takes us about a week to fund a loan like that. Whereas if you go to a bank, it might take them 2 months to produce that loan for you. If you're buying this property at auction, you're going to miss out on that deal. And so they're willing to pay a higher interest rate to Ignite funding because they know that it's going to be a short-term loan, right? 6 to 18 months in duration is very short, and so they're willing to pay a little bit higher interest rate because it means they can either acquire that property or move forward with that property quicker. Another reason why folks use us, right? We're expensive money. We know we're expensive money. They know we're expensive money. But if we're the difference between having to bring on equity partners and having, the profits themselves, it might be worth paying that, 12% to Ignite funding. And of course, we pass 10, 10.5, 11, up to 12 down to the investors versus having to pay 15% in perpetuity on that project in equity moving forward.
Okay, so we got Eric Bose. He says, how big is your warehouse line of credit, and do you keep and service that debt?
Yeah, so we service all of our own loans. So we are a commercial mortgage broker. We originate these loans. We service the loans, handle the entire default and foreclosure process. Right now, we're servicing about 220 million in loans, and we've got about a $20 million line of credit. And that's important because when it comes to funding these projects quickly, say we have a $7 million loan that we need to fund by next Wednesday. If we're only able to raise 4 million of that using private investor capital from folks like yourself, we still need to meet our obligation to that borrower. And so we will front that 3 million to the borrower using our own line of credit or our own cash supply. And then what we do is we keep offering that to investors and we assign them into that loan after the fact. Meaning as soon as you get everything into us, your funds, signed documents, you're up and accruing interest immediately. So it's a way for investors to quickly put capital to work. It's a way for us to meet our obligations with these borrowers because that's a big reason that keeps them coming back is when we say we're going to fund on a certain date, we always hit that date, whether it's using private investor capital or using our own funds.
Okay, we got 3 minutes left. Can you invest with qualified funds or IRAs? What structures can be used?
Great question. So I would say most common is your typical checking savings brokerage account. People can use qualified funds if it's in a self-directed IRA with self-directed IRA custodian. You can do solo 401ks. You can do family trusts. You can do business entities. So multiple different accounts that you can get invested into these projects. And really quick, you did ask just about kind of how we handled 2020 in terms of defaults. Luckily, we haven't had any of our borrowers default on any loans throughout all of COVID. And even before, I think it's been about 3 years since we last handled a default and foreclosure. So we've been very fortunate, but also, we've been keeping an eye on these borrowers, making sure they're in good financial shape. So things have been going very smoothly for us over this last year and a half.
Okay, one last question on how you guys get paid and who keeps the origination points.
Yeah, so Ignite Funding, as I mentioned, we're a commercial mortgage broker. So we charge usually 2 points origination to the borrower. And usually they're getting charged 12% note rate of interest, right? So we're collecting those origination points here at Ignite Funding. That's how we keep the lights on. And then also we're servicing these loans. So if we're charging the borrower 12%, we're usually passing along that 10, 10.5, 11%. And you, the investor, get that full amount in the form of a monthly interest payment.
I think we might have time for another one, which is, what are the tax implications of this type of investment?
Yeah, so if you're going through your typical checking savings brokerage account, you're going to get a 1099 INT, 1099I at the end of the year. It's just a single 1099I. Even if you invest in 10 different states, it's very clean that you only get that one 1099 tax document.
Well, you answered so quick. I got one more for you. You told us the market you're serving. What was one of your most surprising markets where you were seeing a lot of growth?
Yeah, so I would say both Las Vegas and Boise, probably over this last year, we've seen an incredible amount of growth. Being that we're here in Las Vegas and I live in Las Vegas, it's been very clear seeing how many people are moving here, how quickly these home prices are going up, right? These people moving from California are used to paying, $2,000 a month plus in rent. and they realize they can come here, that might get them a 1-bedroom apartment. Here they can come buy, a 4-bedroom house. So the amount of entry-level homes that are getting swooped up as they're getting constructed is absolutely incredible. And then we started lending more in Boise in 2018, 2019. But that market has absolutely exploded. And so we've done quite a few loans there over the last, year or two, and plan to here also moving forward. We think it's, Denver, but about 10 years behind.
All righty. Thank you so much. I think this was very informative and great. We thank you for your time, and your info's on the screen. And if anyone wants to get in contact with Kobe, you can get his info on the screen, or feel free to ask me and I'll connect you. That's jeremy@flya.org, and I'll connect you right away. Thank you so much, Kobe. We really appreciate it, and we appreciate your time.
Yeah, thank you guys so much. Have a great rest of your day.